Chamath, you did a fascinating podcast a couple years ago with Kara Swisher, and you've had a lot of interesting conversations with her. And you talked a lot about Silicon Valley and about how the culture is broken and the system of capital formation is broken. We'd love for you to talk a little bit about your explanation of that theory, as well as how you think the pandemic might even exacerbate that shift that we're seeing out of Silicon Valley, or some of the disillusionment that people in the tech industry are seeing with Silicon Valley.
So I think that there's a dispersion happening, and that dispersion is not dissimilar to what's happening in the public markets. If I had to characterize the public market dispersion, it's essentially that we are separating the haves and the have-nots. And the haves are companies that traffic in bits. So, Facebook, Apple, Amazon, Microsoft, Google, above all others. But then underneath them, largely founder-led technology businesses, okay, that have the 80 to 90% gross margins, even if they're unprofitable. So those are the haves, they traffic in bits. The have-nots are the companies that traffic in atoms. If you're a hotel company, an airline, an auto business, those businesses are incredibly impaired. And there's been a dispersion and a spread where you could basically, essentially, if you bought the weighted S&P index, which essentially is a way of getting synthetically long these handful of tech businesses, and shorted the unweighted index, which is, basically getting an equal weighting of everything else, you can see this massive dispersion and spread effect. That's happening in private markets as well, except what we're looking at are companies that either are benefiting from the pandemic, so tailwinds that are driving positive growth and profitability. So companies like, Coinbase or Instacart or Palo Alto Networks, which is public, or Netscope, which is private, internet security businesses, or Slack, which is a collaboration business. So there are these companies, a mixture of private and public. And then businesses that were second and third tier also-rans are, again, just getting crushed. And they're being forced to fire and lay people off. Underneath that dynamic is something that's been broken in the Valley for a while, which is that the cycle of building and profiting from companies has taken too long. It used to be the case that we would build a company for 4 to 6 years and then take it public, and then the public markets would participate in the last 2 or 3 years of evolving the business. Now what happens is there's so much private money that these companies stagnate in the private markets for 8, 9, and 10 years. The problem is that for LPs, it doesn't work, because you have these 10-year fund lives, and if you're a growth fund, maybe a 7-year fund life with a couple 1-year renewals. The timing mismatch now that it's creating is this massive overhang where you have these paper values and IRRs that can't be monetized. And so that's feeding a cycle where, even faster than normal, LPs are looking at secondary firms and saying, let me sell some of these things, let me rebalance my portfolio because my publics are getting crushed. If you look at private equity, it's very challenged because they predominantly traffic in atoms. They're buying industrials companies, they're buying things that are real, tangible things that you buy with, current free cash flow. That stuff is very, very challenged. And so as a result, the IRRs that these pension funds and other LPs will see are going to be challenged. They then look at their venture exposure and say, wow, I have way too much exposure. And so then they're selling. Then the venture funds themselves are thinking to themselves, wow, I'm having a lot of trouble raising a new fund. So it's a very complicated cycle, John, but that's what we're engaged in right now is this essentially a massive multi-year long portfolio rebalancing. And, the publics are leading the way, so that dispersion is creating a dislocation. Private equity is the next domino to fall, because when they really reset their portfolios and revalue them, 2, 3, 4 quarters now into the full scale breadth of the consumer demand shock that we're dealing with. And then venture folks will have to take the back seat, but it's going to make valuations very challenging in the public markets, and you're going to be rewarded for having money.